today, Happy Bear New Year. And again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Today, I'm joined by Tarek Brooker. Hi, Tarek. How are you going?
Pretty good yourself, mate?
Yeah, pretty good. New year, same old problems.
Yes, and there is an awful lot of data to talk about all those problems, isn't there? There's the stuff coming out of China that they're trying to reflate their property market. We've got our own little issues here with our property market, and then there's the Fed, and there's all manner of data related to that, and there's plenty to talk about.
Absolutely, and of course the old Fed minutes that came out yesterday stirred a few people up because they're still fixated on fixing inflation, putting rates higher. So that's the first big takeout, and it's the same as last year, only more so, I guess. And I'm fascinated now by slowly some of the sort of the mainstream economists, quote unquote, are beginning to actually come around to the view that, well, maybe actually rates will go high, and maybe a recession is more likely, and maybe rates will still be higher in 2024.
It was interesting, like recently, I think it was Stanley Druckenmiller came out, who's, obviously a legendary investor and someone notable in the community. And he basically said he would be astounded if we have managed to avoid a recession, as in the US managed to avoid a recession in 2023. And it's kind of a hard assertion to disagree with. And it's, if you look at things, across the board, they are deteriorating, but they're also holding up just strongly enough to keep rates rising. And that's as equally true here in Australia as it is in the US.
That's right. And of course, rising rates in the context also of rising wages means, of course, that's another inflationary pressure that everyone's got to navigate. There was an interesting thing that came out from St. Louis Fed today. It was in their blog series, and they actually were showing some of the metrics they use when they're measuring information, not at a federal level, but at a state level. And what's interesting is, I might put the chart up, to show that, in fact, last October, above the threshold number of states were actually negative in terms of their metric. In other words, probably the US was in recession last October. Different set of data, but another data point.
Yeah, it's quite an interesting one, because that's one that's been around for quite a long time. I mean, it's not something that's been, shall we say, super notable, but it is something that is sort of on the radar within the analyst community, and it is something that people have relied upon in the past. But I mean, I guess it also just goes to show that the divergence that we are seeing in the economy in Australia and in the US of sort of the have and the have not, and maybe we're seeing that even at a state level. These more affluent states where people have greater levels of savings, greater levels of available credit, and that's driving things higher. Whereas maybe in other states, in other suburbs, say here in Australia, where people don't have that same scope for credit and borrowing and savings, things are quite a bit different, unfortunately.
Yeah, I think, it underscores what we keep talking about, which is granularity. You have to go into detail. You can't just talk at these aggregate levels. It's a bit like home prices, home prices are up or down a few percentage on average, but it doesn't really tell you much, because that in some places prices are moving quite fast in up or down directions, others less so. So really getting close to the data and getting close to that granularity is really important, particularly now when there's so much information, but also so much which is contradictory.
There is, and I think part of the problem at the moment is that people are struggling to interpret the data, and they're struggling to sort of put together these narratives that sort of tie together how we as humans perceive markets and how we perceive, the economy around us. Because it's, in the past, it was relatively easy to go, this is good, this is bad, and things were all going in one direction. Tina, there is no alternative. You've got to invest in stocks, you've got to invest in property, blah, blah, blah. But now there is an alternative, and you can whack your money in the bank and get 4.75% or 4.5% in a term deposit. It's completely transformed the way the system works. And I don't think that everyone, or even the majority of people, have entirely adapted to that, shall we say.
Very good point. If you think of property investing in net returns, on a cash flow basis, more than half of property investors are underwater, so they don't make any money at all from the cash flow. Banking, of course, on equity growth, but if there's no equity growth, then there's no return, compared with, 4.95, which you could get a little while ago in term deposits. Whole new ballgame.
Well, exactly. I mean, if you're particularly if you're someone who is moving towards the end of their working life and the end of the benefits, the overwhelming benefits of negative gearing, a 4.9, a 4.5, 4.95% term deposit on a 5-year basis is all of a sudden starting to look like a pretty attractive option, because, rather than, losing money on your investment property, you've got a choice of taking the cash and walking away. And in a lot of places that haven't seen those really outsized falls in property prices, that might be a pretty attractive option for someone who wants to, transition towards a more sort of fixed income type of arrangement or retirement.
Well, certainly there are a few people in my surveys who are in that mode of operation. That's one of the reasons why, although listings are down, I think we're going to see a bit of a spike in listings now, and some people under forced circumstances, but most people who are listing are looking to release that equity before it disappears.
Yeah, that's a good point, and I'm actually really curious because I know you've been doing the intention to transact data on both sides of the spectrum for a long time now. So, are we seeing sort of like going into the new year? Are we seeing an increase in that intention to transact overall, or is it just sort of isolated to certain demographics?
It's skewed. So, if you look at first-time buyers, they're definitely not wanting to transact at the moment, not able to because of the borrowing power reduction, but also because of the fact they think prices will fall. But if you look at those people with investment properties, a number of those are looking now to try and get out. And interestingly, there are also some people who are in down trading mode, so they've been sitting on property for some time, they've got a lot of equity, they're looking at those term deposit rates and thinking, well, maybe now's a good time to downsize. I can perhaps buy a smaller place because there's a bit of stuff around, and get some equity that I can then put into other places, avoid the stock market, avoid property, avoid the bonds, and just go safe for a year or 2 or 3. And those things together are enough to really change the dynamic of the market.
Yeah, they are. I mean, like as you say, because it's all about that balance between supply and demand. Like you do have that conversation where obviously credit availability is arguably the most key factor, but supply and demand is also a significant driver of outcomes within the property sector. I mean, if we had have seen, like, for example, in terms of transaction volumes, and this is something I'll get to with the chart later in the show, but in terms of transaction volumes, we've seen transaction volumes in Australia fall below the 5-year average prior to 2021 since October. Now, that's quite notable because transaction volumes were depressed between the middle of 2017 and the middle of 2019 because of the property downturn, the Banking Royal Commission, all those factors. And then again, obviously, property transactions were low again in 2020 because of the pandemic. So if you're seeing depressed property transactions below that already depressed level, that's a sign, I think, that we could start to see old stock start to grow on the market. And that's a point that Louis Christopher from SQM recently raised in the Australian Financial Review.
I think he's right to do it, and certainly there's a lot of long-standing stock. Also, some of the quality of stock that's coming on the market currently is pretty crappy. So there's a lot of investment properties that haven't been maintained properly, for example, where people are now trying to get out and release equity rather than invest yet more money in trying to fix up. And there are new rules that are coming with things like fire alarms and other things which are actually requiring further investment. There are also, though, some diamonds in the rough amongst those properties. So there are some people who have genuine reasons to move and are also looking to sell. And so it's very important to go property by property by property and don't assume they're all the same, right? Because there are some good value properties still available, but there are also some pretty rubbishy ones too.
There are, and I mean, I've spoken to a few people recently who have recently invested in property, mostly in regional Queensland, and sort of the outer areas of some of the capitals. And if you do your homework and you look at the yields and you really look into it, you can find some gems. There are some properties out there which are positively geared even at higher rates than what we're seeing today. They do exist, and yep. To those people who want to find a property and positively gear it and be ready for come what may, good luck to them as far as I'm concerned. That's great. That's what investing is meant to be all about: getting a return, paying off an asset, and improving your lot in life.
Correct. And, doing the work, making sure that you understand what you're buying and separating the sheep from the goats. That's something I've been preaching for, many years, but it's never been truer than now. So it's very important to look at the local area and to look at the local property dynamics and look at the local individual properties looking at and picking out the good from the bad, because there are still some quite good offers around. And again, I've spoken to a few people who've actually transacted relatively recently at reasonable price. They've got a really good deal and got a really good property, and they're very pleased that they're actually now in the market, as you say, positively geared rather than negatively geared, and are set up. So, it goes to show that this top level narrative, property's booming or property's crashing, well, it doesn't tell you anything really. You've got to really do the work and go granular.
Yeah, you do. And I think it's also just important that, some of the people that I've spoken to have really done their homework, not only on where rents are at now, where mortgages are at now, etc., but also looking further into the prospects ahead for some of these towns, where you're saying, additional capex, additional infrastructure, things that are going to help boost the lot in life for people in those specific areas,
Yep.
which are going to help support the property value even through challenging times, because frankly, the properties are already relatively affordable. So, I take my hat off to people who do the homework.
Yeah, absolutely. Well, those who do, statistically speaking, have a much better outcome. And the other final point on this is you need to take a 3 to 5 year view, not a 12-month or 24-month view. Most people, unfortunately, are looking at it in too shorter terms. But if you take a 5, 8, 10-year view, then the costs of actually transacting also get spread out over a long period of time. But there are still people, frankly, just looking at it through the wrong lens. So it's about how you look at the proposition, I think, which is really critical.
Yeah, well, it's like some of those brokers say their best clients are the ones who are dead, because they're the ones that have just bought the thing and they've they did the homework at the time and they've held on to it.
Exactly right. Well, let's move on to the charts, because otherwise we're going to run out of time. So we said hello, Happy New Year to the Bears, or Happy New Bear Year, or Happy Bear New Year, right? And here you go.
Yeah, it's quite a nice little one, isn't it? I think it's quite fitting, considering some of the comments by the IMF recently, and even some former, even Alan Greenspan talking about a recession in 2023. But without further ado, as usual, the charts will be available at avidcom.substack.com, and any contributions you make are very, very much appreciated, and we'll get right into it for the first chart show of the year. Okay, now I'm going to go through this slide, and I'm going to try not to get frustrated, but I make no promises. In the world of Aussie property, we have this idea that things aren't so bad, that Aussie property is performing, okay, property prices are falling, but it's orderly and blah, 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 blah. And I will concede there is minimal panic. It has been relatively orderly, but the price falls that we've seen have been very large. This chart starts at the beginning, for the US comparison, starts at December 2007, which is when the National Bureau of Economic Research in the US believes the US entered recession. And it also starts for Australia on the 1st of May 2022, which is just a few days before the RBA started raising interest rates. And so far, at a 5 capital city level, property prices in Australia are falling about 2.5 months ahead of where they were in the US during the financial crisis. Now, one of the reasons why this is particularly notable in month 10 for the US is because that's when the Lehman meltdown started, and that's when crap really started to hit the fan. Yet our prices are still falling faster than that. So I think that's really quite notable, and it just needs to be kept into perspective, because it's all well and good to go, oh, well, prices in Sydney are only down a little over 12%. It's like, yes, but relative to the most well-known housing crash in the modern era, they're falling a lot faster.
No, I think it's a very good point. And, people will say, yeah, but if you go back another year before that, then property prices dramatically rose in Australia. They didn't dramatically rise in the US. So maybe we're at a sort of a higher peak. But the trajectory down is quite startling. And remember, this is a bit averaged, right? We know that in some areas prices have dropped even further in some places for some types of property. In other areas, not so much. But this is a very important leading indicator, I think, that things are not that chirpy.
No, they're not. And I think it's just worth noting that there was quite a few people who, during, sort of the end of October, start of November into December, who were saying, oh, no, things are going to bounce back. Things are going to get better. The property is getting close to bottoming and blah, 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 blah. Yet it was seasonality.
Yes, correct.
They didn't account for seasonality, which is something that I wrote about in October, and I predicted that price falls would moderate, and hey presto, they did. And it's just interesting because people just keep looking for these positive narratives, and I'm perhaps I'm just a little bit closed-minded, but I'm struggling to find them. I recently did an article, I'll get you to put it in the description, on basically how you've got these things like in terms of like immigration boosting property demand and all these other factors. And while I see them providing a boost, I struggle to see how in the short term, say over the next 9 to 12 months, that manages to overcome the ongoing falls in borrowing power, unless there's some form of intervention, whether it's TFF 2.0 and another couple of $100 billion thrown at the banks, or whether it's the RBA slashing interest rates and just saying we're going to let the currency burn, whatever it may be.
Yeah, well, there's plenty of things they could do. I'm waiting for APRA to reduce that buffer. That would actually make a significant impact. There are a number of people who are thinking that could happen quite quickly, as well, of course, the longer term mortgages and all sorts of things. So there are things that can be done. But what's interesting is that the expectation I have is that we're going to see the little sort of smoothing that we saw because of the seasonality work against us in January through to March, because effectively that's when the next leg down is likely to happen. Remember, more rate rises probably from the RBA in February and maybe beyond that. The markets are still saying a higher rate later in the year. And most economists, not all, but most economists are suggesting no drop in RBA rates through 2023. So rates are going to be higher for a long period of time. The other interesting observation, the statistics came out today for the population across Australia, right? And guess what? We have a smaller population and we have an older population because of the lack of migration and all the temporary migrants who left. That's another factor that's actually negative to property demand and property prices.
Yeah, in relative terms to where we would have been. Yeah, yep. Absolutely. And although by the same token, in some of that data, they're talking about Australia ramping up immigration to well over 400,000 a year and having a population of, what was it, 60 million? 50 million by 2060.
Yep.
I don't see how that ends well. But that's just me.
Depends on the sort of place you want to live, I suppose. If you want to live in high-rise rabbit hutches, not a problem. But if you want a bit more of a lifestyle type situation, maybe away from some of the traffic and everything else, then it doesn't play well.
Well, the thing that's interesting about that is that there are some, small high-rise apartments in other cities in the world which are perfectly serviceable, and they have great green spaces, they have terrific amenities, great transport, but we don't really make those in the same way, do we? We go out to the outer suburbs, where there might be a train line if you're lucky, and then we build a bunch of mixed-use apartments like those ones that Edwin, likes to talk about. He did those videos on a couple of years ago.
Yes.
And then, and it's like, I'm sorry, but this is not the center of Vienna. It's not the center of Paris. It's not within, walking distance of a tram or other forms of transport. It's a very, very different prospect. But, that's the situation that the government and the RBA and APRA have created, because that's what people can afford. And it's the way people choose to live should be their choice. Let me just put it that way.
Yeah, and of course the IMF report that came out made the point that the property market in Australia is highly distorted, and property prices need to come back significantly to bring affordability back into normal ranges. It's just worth bearing that in mind too.
Yeah, and I'll get to that in a couple of slides' time.
Excellent.
Okay, this is what I was talking about in terms of the sales and turnover within the market are falling below the previous 5 years prior to 2021. And it's also, in fairness, it's also important to sort of emphasize that we are talking about a market that has extremely depressed levels of stock overall. While stock levels are now rising, we are seeing those older listings starting to mount up. Overall, we are still in a very, very depressed place in terms of overall stock, and that is something that is supporting the market. So the question for 2023 is, are stock levels relative to demand going to rise significantly enough to put yet another downward force on property and cause prices to fall even quicker?
Yeah, and the answer is it depends a little bit, but certainly there are some signs in my surveys of more people, as I said earlier on, intending to list. And talking to a couple of agents recently, they've got quite a pipeline of listings coming on through January. So I wouldn't be surprised to see the numbers significantly higher than where they currently are. How high, of course, is the question, and to what extent do they just stay there and become stale? That's the unknown question.
Yeah, and that will ultimately be what decides the direction of prices. Whether or not we sort of start to see prices accelerate, further down, or whether or not we just sort of see them, sort of, I wouldn't quite call them stagnating because they're still falling, but just sort of staying roughly where they are in terms of month-on-month figures.
Well, could well be. The other point, of course, is what the banks do. So it's interesting, a couple of the banks are chasing volume quite hard at the moment, and they've actually reduced some of their underwriting standards a little further. And some of the banks are now taking the previous underwriting when somebody got a loan. If they're refinancing, they're not actually doing a new assessment. They're just taking the one that was done previously and just saying, well, if it was okay, then it's okay now. So that could play well into some risks down the track. Although, of course, APRA did introduce the 1% countercyclical buffer from the 1st of January, right, which is interesting timing.
Well, I think that they see, I mean, they're not idiots. I mean,
I must be careful what I say, relatively speaking.
I mean, they have to see that, the writing on the wall. I mean, they've got the IMF screaming at them. They've got, all manner of analysis saying that, that there's significant downside ahead. And you've got some of the world's most legendary investors, people like Druckenmiller and Grantham and people like that saying that this could get real. And, you'd be a fool not to prepare your banking system for that. And whether or not they've prepared it adequately enough, well, we'll see. I mean, I think it's just going to depend entirely on how much the government is willing and the RBA are willing to help out again.
Correct. That's the big question. Mind you, of course, the APRA deadline was imposed by BIS, right? So they had to do it. So they really got no choice. So they dressed it up a little bit and sort of snuck the announcement out in the quiet period, hoping nobody would notice. But I did.
Well, I mean, I guess we're still at work, aren't we? We're always, eagle eye on the board on that type of thing.
There's a few things being snuck through over the quiet time, but we most of it we've noticed and commented on.
Yeah. Okay, now this is a really interesting one that someone on Twitter put together. They basically did a bunch of different countries and looked at how per capita. How economies grew per capita over over depressionary periods, and one of the economies they covered was Australia, which I thought was really interesting. And Australia in real GDP per capita terms is performing worse now than it did 16 years after the Great Depression, which I think is really, really something. That we just aren't seeing that same level of growth that we saw before the financial crisis. And I just think it's worth noting that, people talk about Japan's lost decade, yet the last decade for Australian households in a lot of ways was worse in terms of in terms of growth and outcomes. And if you factor in the fact that living standards decreased significantly in terms of congestion, in terms of a lot of other different social services for quite a few households living in urban areas, even for some in the bush who've seen, health services and education decline. It's not really a great picture, yet we keep getting told we're the greatest country in the world and everything's fantastic.
Yeah, well, there's two observations. The first is, of course, it's GDP per capita, right? Yeah. And, of course, we keep increasing the population, so that dilutes GDP. The other is it's in US dollar terms. And of course, the US dollar value relative to the Aussie dollar was a bit different in those three scenarios. So there's a few fuzzes in there, but nevertheless, the takeout is consistent with what I'm seeing with some of my surveys, which is that relative to, say, 10 years ago, households are actually not feeling like it's been a good 10 years. They're actually in more difficulty now than they were. So to my mind, that's a really important observation. Of course, real wages growth has almost gone nowhere. Mind you, corporate profits, different story altogether.
Well, ain't that just what it's all about? Okay, now this is what I was talking about with regards to home affordability when we spoke previously. And currently, once the latest RBA rate rise from December has been priced into variable mortgage rates based on the average rate payable from the RBA's own data, we're looking at about a 5.6% variable rate. That's sort of ballpark. And as you can see, and I know a lot of people have said that that I focus too much on Sydney and Melbourne, etc. So I've done all the capitals as to what percentage of the gross median household income is. Now, what I've done is I've taken the 2021 census data and then I've extrapolated the wages growth that has occurred since. And then I've just put this little thing together, and basically it just shows that even if hypothetically, say, property prices in Sydney were to halve, they would still be the median household would still be consuming 39% of their income, of their gross income, to service a loan on the median house. And I think that's really something. And just one more point before we continue. One of the key things about this is that where we are sitting now in terms of mortgage rate is slap bang in the middle of where Philip Lowe and the RBA believes the long-term average should be.
Nope.
So this isn't, oh my God, this is high rates that we're all going to die. This is, hello, middle of the range, middle of neutral. This isn't even technically a contractionary impact on the economy as far as they're concerned, even though I'm fairly certain that it is.
Well, that's right. And the concern, of course, is that rates may go a little higher and that will push mortgage rates even more. Interestingly, in my modelling, what I do is I look at the disposable income and actually show the disposable income relative to the average mortgage payment and rental payment in a particular postcode. And we quite often now are seeing numbers of 40%, 45%, or even 50%. So a lot of people are spending a hell of a lot of their real income, disposable income, on just paying that mortgage or paying that place to live. We are off kilter. The IMF was dead right. We are off where we should be in terms of affordability. And like I said in one of my earlier posts over the holiday period, you got to understand this is not economics. This is politics in play. This was a political decision taken over the last 20 years to effectively pump up the economy, allow people to borrow more, to be able to buy bigger mortgages, houses, etc., to increase the profitability of the banks, etc. This is a politically designed outcome. And unless politics changes direction, we're going to see this continuing.
Yeah, I think it's interesting that there's this argument out there that the sole factor in this is low rates. Now, I don't buy that. Like, if you look back at standard variable mortgage rates, if you go back all the way into the late 1950s, right, between 1959 and 1968, the average standard variable rate mortgage in Australia was between 5 and 5.5%. Very, very affordable. More affordable than it is now.
Yep.
Yet, did prices go to the moon? No. Prices stayed in a really positive place. It allowed millions of Australians to get into their own home. It helped promote one of the greatest economic growth stories in history. You saw real wages roar. You saw living standards rise, and everything was great. Yet instead of going, maybe we should look back and go look at these settings that worked, we go, no, we can't do that because that would require us to have our houses lose, 30, 40, 50, 60, 70% of their value, whatever it would take to get it back to, a reasonable kilter. And oh no, we'd have 7 or 8% more of our disposable household incomes left to spend on businesses, left to spend on, doing whatever the hell it is that we want to do with our own money, rather than just giving it to the bank to pay off the interest and pay off the principal on our enormous mortgages.
Yeah, and this is interesting. If you go back to the 50s and 60s, the typical underwriting ratio, was 2.5 times the first income and maybe +1 of the second income. And that was pretty much all you could borrow, right? And that put a significant lid on how high prices could rise because people weren't able to borrow, massive amounts. Now it's 6, 7, 8 times. There's your problem. Plus, of course, the ultra-low interest rates. Those two things work together. And, of course, the deregulation of the financial system to allow a lot of people to use securitization to be able to create cheap funding, to be able to actually fund more. All of those things are part of the story. Plus the financialization of property, plus the tax breaks. So there's a lot of complexity here, but it's all focused around the same things.
I think that, and this is something that I want to, get into in a lot more detail in an article down the road, but I think we as a society need to sit down and we need to discuss how much is the maximum that someone should be paying on a mortgage. And we should have a discussion as to who and in what job someone should be able to afford. Should a policeman be able to afford a house? Should a nurse be able to afford a house? Should a teacher? At what job level do we say, no, sorry, things have changed too much? And even though a postie and his wife who did part-time work at the local school canteen could afford a nice house in the 1970s, 80s, even the early 1990s, get stuffed, you can't afford it, deal with it. We need to have that discussion. And I think it's really, really crap and just more than a little bit painful, I think, for non-homeowners in general, of all ages, I might add, and even people who aspire for their children or their grandchildren or their friends to own a home. We need to have that discussion, and we need to be able to say to people, well, should you be able to own a home? Should whoever should my mate the tradie, should your friend the nurse, should whoever? I think that's something that we need to discuss rather than just going, oh, it's a market. We all know that's bullshit. It's not a market. I mean, I think Jess Irvine said it quite well today in the Sydney Morning Herald when she said that this isn't about economics. It's not about market forces. It's about politics.
Correct.
She said it at absolutely every level. And I think that she's 100% spot on. And she's not the only person to say that. It's not just, the frustrated members of Gen Y. It's Louis Christopher. It's Shane Oliver. It's pretty much everyone who has any real experience of how this all works.
Well, that's right. So you've got neoliberalism, you've got the idea of let the markets be the markets and don't interfere, and that then sets you up for essentially taking down a particular direction. Mind you, of course, this isn't just an Australian thing. This has been driven internationally. So pretty much all property markets in all Western countries are as distorted as they are here. We've probably got the worst, but the UK is pretty bad. Look at New Zealand. There is a set of fundamental philosophical principles that have actually led to that. Decisions were taken, outcomes were actually engineered. And it's like I said a little earlier on, unless we actually change the rules of the game, we're not going to see anything change. And there will be tweakings at the margin, so we'll see more first-time buyer incentives. The Productivity Commission said that doesn't make any sense. It just lifts property prices. Well, we agree with it. Absolutely right. Or you provide more tax breaks to allow property investors to get even more support or more first-time. Whatever you do, the more they intervene without actually intervening in the core issues that we know need to be tackled means we're going to get further from where we should be. And as the IMF said, we've got a distorted, completely inappropriate affordability model at the moment for property. So it needs to change. But these are not conversations that politicians want to have.
I'd be happy if they just left it alone. Like, I realize there's already existing things distorting the market. There's negative gearing. There's the capital gains tax discount. There's all manner of different things distorting the market. Okay. I'd be happy if they just left it alone. Like if they had left it alone in 2020, we wouldn't be sitting here having the same discussion today. Things would be very different. If I had left it alone in 2008, things would be very different. And the thing that gets me is I was going through the Bank of International Settlements data recently on debt servicing ratios.
Yep.
Right? Now, when you think of Americans, you think, wow, they've got healthcare debt, they've got student debt, they've got auto debt, they've got debt coming out of their ears. Yet their household debt service ratio is almost half what it is in Australia.
Yep.
right? And it's also worth and important to note that household debt service ratio, that was based on rates at 0.35%, not rates at 2.85 or 3.1 or wherever it is that they're going. So, we're looking at a scenario where we are going to be paying 2.5 times more as a proportion of our household incomes on our debts as the Americans. And they've got all these horribly high interest rate things like auto loans and student debt. Yet, what do we get? We don't have all these other things to show for it. I don't have a Dodge Challenger Hellcat that I'm paying $1,200 a month on, or some big home reno that that I've managed to do, and I'm only paying 7.5 or 8% of my household income on. No, we don't have that. We don't have anything. We have bugger all to show for it, and we just keep jamming more and more money into debt servicing, and it doesn't make any sense. Like, why wouldn't you want that money to flow through the economy, to go to different businesses, to raise wages, raise living standards, raise our ability to consume from local businesses? It really is a no-brainer. But there's just too much political inertia with the status quo.
But we have some wonderfully profitable banks, some of those profitable banks in the world, right? And of course, they are unquestionably strong, quote unquote, aren't they? So, there's no financial stability risk here at all until things go wrong.
Well, that's what you ask anyone, not anyone, but you ask a lot of folks, and they say, well, that's why the RBA will step in. That's why the government will step in. There's always an answer. And it's not a market-based answer.
Yep.
You talk about these bullish scenarios for property, and don't get me wrong, there are some out there. There's the fact that rates could get cut as you see a global recession, and you see immigration ramp to the moon, and maybe that somehow manages to muddle through. And that's a reasonably plausible scenario. But most of the bullish scenarios involve the government or the RBA or APRA or the combination of two or three of them coming to the rescue. And Jesus Christ. We're meant to. People lecture me about the free market. What free market? That's not a free market. That is a government-sponsored wealth creation scheme.
That's exactly right. It's designed for a particular outcome, which is to support the banking system and support the GDP, etc., help to make the numbers look good. But actually, when it comes down to individuals and the individual impact, as the IMF says, we've got a really distorted market. And the only way to solve it, unfortunately, is to let prices come back down to more normal levels. And that then is the big political test and political question, right? Will an incumbent government on their watch be prepared to allow property prices to slide not just a few percent, but a significant proportion, like Ireland, or will they actually try and find a way to stop it? And that actually, to my mind, is becoming more and more the question of the day.
It is. I concur. And one of the things I think is interesting, though, is that the proportion of people that are actually being protected by this, by all these different things is so small. I realize that it's obviously, that there's obviously the knock-on effects. There's the economy. There's the fact that housing is the economy. There's equity mate withdrawals. But purely in terms of people who would find themselves underwater and in significant difficulty, it's not that. It's probably smaller than the total number of people claiming in the variations of unemployment benefits.
Yep.
But we don't really talk about them, though, do we? Those. We don't talk about the people who are getting smashed by non-discretionary inflation rising at 8.4% per year, and them only getting a 5 or 6% increase, and the fact that their rent's gone to the absolute moon. But those people don't matter, right? It's all about housing prices.
And we don't talk very much about how much of the tax take is actually thrown across to property investors and other people, in the housing sector. There's a whole bunch of cross-subsidization going on there as well. So the full real costs of this housing Ponzi is dramatic, and it's sucking out a huge amount of economic activity from the country and taxpayer income as well. But the question is, who's going to diffuse it, right? Because actually it could go off, boom, right? Maybe it's just better to sort of to just not talk about it and hope it doesn't go off on our watch, and then find some other ways to talk about it. Oh, and by the way, if you look at the statistics, there's a lower proportion of people today than ever who actually own their property outright. There's a higher proportion of people who take mortgages into old age, into retirement, and we've got a higher proportion of people who are actually in the rental sector, and the rental sector, of course, is being messed up with very significant rent rises. So this whole thing is, well, it's close to collapse, actually.
Without going off on another rant, someone, I've not, quite a few people have sent me DMs on Twitter. They've emailed me. They've contacted me through various means, and some of them have been elderly, some of them have been young, some of them have been middle aged. It's really been from people across the board, and people have described the situation to me as soul destroying. There are people who live in relatively normal everyday homes in relatively normal areas of Sydney and Melbourne who just want their family close by in their old age, and their family can't afford it. Two people on good incomes, they can't afford it. It doesn't work for them. And I've heard people have moved interstate. I heard from a family. I know of a family who took their entire family from Sydney northern beaches, kids, grandkids, and all, and moved to regional New South Wales.
Yep.
Just took them all, bought the kids' houses, walked away with a whole load of cash.
Yep.
And it's sad. It's sad that needs to happen. That people feel the need for that. That we can't just have a normal functioning society. And I don't know. Obviously I'm biased, and I'm not going to pretend that I'm not. But it's challenging, to be completely honest with you, hearing from these people day in, day out that they're struggling so badly just to achieve what was once upon a time so simple, and there's no real need for it. Life is hard. The universe will kick you in the nuts just willy-nilly, because that's just the way life works. Bad things happen to good people, right? But at the end of the day, that's not the way that we're meant to treat each other. We're meant, as a society, we're meant to lift people up. We're meant to help each other out. That's what human communities are meant to do. That's why human communities exist. Yet instead of just thinking, hey, how can we provide these most basic needs at the lowest possible cost so we can have the greatest possible benefit, not only in terms of society, but also for businesses. Yep. Because it's not doing Joe, the local, takeaway owner, or Jenny, the hotel owner, any favors with all that extra cash flowing into the banks and into the property sector. It doesn't benefit. It doesn't help. And I'm sorry for the little rant, viewers, but I just call it as I see it.
No, you're right to call it. And the bottom line is this: we're measuring the wrong thing. So growth and GDP is probably the wrong measure. But there has to be a different mindset and a different set of priorities. And it comes back. We said this a couple of times, but I'll say it again: what is society for? At the end of the day, that's actually the big question here, right? Because if you regard society as effectively providing a lot of cannon fodder to enable large corporations to get ever richer, which is the current model, that's one way of defining a society. There's another definition of society where, in fact, society is actually for the benefit of individual and small businesses, etc., and everything else is enabling and supporting that, is turning the whole thing on its head, right? I think we have to think very seriously about what sort of society we want, because what we've got is a broken society that is being driven ultimately by greed and by the neoliberal philosophies and free market economics, although it's not really free, as we said earlier on. And in the meantime, there are a lot of people who are just being taken to the cleaners. And, it's not right, it's not just, it's not fair, but it's the standard set of values that most politicians trot out year in, year out.
Well, it is sad, like I say, like with the rental crisis, you hear these stories of, people living in hotels, people living in whatever possible rental accommodation they can get their hands on, whether it's their friend's back shed or whatever it is. And I'm yet to hear anything about it from the government beyond the most basic of basic lip service. And that is deeply sad from a government that claims to be for the Australian people. When you're talking about, almost a third of the population who rent, who are, facing these challenges to varying degrees, and it doesn't even rate a mention. And I think that's just pathetic, to be honest with you. We spent, the better part of the better part of a decade, with the Liberals in power and everyone going after them, rightfully so. And I did the same. I was there. I gave the Liberals all sorts of crap. They could look back through, years of our videos together to find that. But Labor deserves to be taken to task as well, because not only are they not addressing the issue by ramping up, the non-humanitarian permanent migrant intake to the highest level ever, and seeing the number of temporary visa holders, that'll probably hit a new record high within the next 2 quarters, I would imagine. Mm. It's creating a really, really challenging situation. And, without going on to yet another rant, it's sad because the people who are going to get the wrong end of the stick are going to be the people who don't deserve it. It's going to be the immigrants. It's going to be those people who people see as the most public and obvious symptom that they can see of the problems facing them are the people who get the short end of the stick, because that's the way it nearly always works. And that's sad, because people, immigrants or not immigrants, whatever, immigrants, Australians, temporary visa holders, it doesn't matter. People don't deserve to be blamed for ththings that are not their fault, and they deserve to be respected.
I agree on that, and it's worth just reflecting 2/3 of people either own property or have a mortgage. So there's a greater proportion of people in the property rather than outside the property category, which means that from a political perspective and votes perspective, that's always going to bias. And the other is, of course, that politicians generally have more properties than average. So they have some vested interests in actually maintaining this sham that we've got at the moment as well. So again, another reason why perhaps sometimes things aren't done that should be being done.
Yes. And I should probably get on to the next slide before I go off again. Okay. As many of you may know, I monitor the number of used cars for private sale on carsales.com. I've been doing this now for a little over 3 years, since the end of 2019, and we are currently seeing near the high. We recently had a record high for the data set, and we saw a little bit of a seasonal lull over Christmas and Boxing Day, but before New Year's, the number of cars on the market for private sale started rising all over again, and that is not normal. That has not happened before in the history of my data set. Normally, you see things be relatively quiet over the holiday season and into Australia Day, and you see stock levels continue to decline, but not this year. This year, before the bell struck midnight on New Year's Eve, the number of cars on the market was already rising again, and I expect a new record high to be recorded, and probably by the end of the month at the rate things are going at the moment.
Well, that's consistent with my surveys that show that people are looking to generate cash, and one of the things to do is to move a car on, or move a caravan on, or something else, because of course that is a way of creating some cash up there. So I think it's a very significant thing. And I was looking at some data from the US, because there's some similar things happening over there too.
No, indeed, it's going to be an interesting one.
Yep.
Okay, now I promised to talk about this, and I'm going to do the best I can with the remaining time that we have after my little rants. Recently, the Bank of Japan removed the cap on the 10-year bond yield, which it's very similar to what the RBA tried to do with the 3-year bond yield here in Australia, where they capped it at 0.1%, or at least they tried to, until it blew up in their faces. Now something similar is happening to the Bank of Japan, and yields, they moved the cap from 0.25% to 0.5%, and today, guess where the Japanese 10-year yield is? 0.5%. So despite the fact that they tried to raise the yield cap in order to take some pressure off the bond market and some pressure off themselves in their ongoing intervention, that has completely failed. In 5 of the last six days the market has been open, the Bank of Japan has been forced to step in and buy billions and billions of dollars worth of the Japanese government's own 10-year bonds in order to keep the yield below its new target of 0.5%. But as you can see from the 10-year yen swap rate, which used to run very, very closely with the Japanese 10-year bond yield, that has blown out now up towards 1%. So that is roughly where the market thinks yields should be for this type of duration of bond from the Japanese government. So the problem with this is that, one, the Japanese own a lot of bonds, and two, as a reserve currency, it is also a benchmark. So when they raised the yield cap, it basically meant that bonds globally had to then be repriced because a lot of Japanese. Okay, I should explain here that, say for example, you own a Japanese 10-year bond. It pays 0.25%. Now that doesn't sound very appealing, but a lot of Japanese pension funds and even retail investors buy bonds from overseas. So for example, they buy US bonds. They hedge the yen into US. They hedge the US dollars into yen, and then they buy, say, a US 10-year bond. And that's been quite an attractive prospect, particularly with a weakening yen. So say hypothetically you bought a bond when it was 100 yen to a US dollar, you buy that US dollar bond, you collect your 1.5% coupon, which is better than the 0.25 that you're getting, and maybe you only make 0.25, 0.35, 0.4. It's not a huge return on top of what you'd be getting from your Japanese bond, but you also have the potential upside of the capital growth if the yen depreciates against the dollar, which has been quite attractive recently. But now that Japanese yields are rising, buying those offshore bonds, including Australian bonds, the Japanese own quite a lot of Australian bonds, is no longer as attractive. So it's forced yield higher. Now, the problem is if they're forced to raise the yield cap again to 0.75 or even to 1%, which is about where the market thinks things should sit in terms of swap rates, then you're going to see a further repricing of bond yields. And I've got a nice little chart, which I'll just bring up now, showing the impact on the Australian government 3-year bond with the Japanese government, with the Bank of Japan's intervention, where they raised the target, circled there. You saw the big blow off at first as the market tried to price in this new reality. But since then, as you've seen, there's been further upward pressure. So if it breaks again and they're forced to raise the yield cap again, then we could see further upward pressure on bond yields, including Aussie bonds, which has quite a lot of implications for Australian interest rates.
Right, and overlay the Fed talking about higher rates than previously, another force putting bond yields higher as well. And you got to say that the bond markets are relatively unstable at the moment. So these are the sorts of things that could create significant impacts.
Yeah, exactly. And just to go back to one of the other slides here, the Bank of Japan already owns half the Japanese government bond market. So we are seeing this, this distortion, shall we say? And the more they buy, we could see potentially even larger swings. Just earlier today, we saw the Japanese do an unscheduled bond buy of 300 billion yen, which is about a bit over 3 billion Australian dollars, sort of 3.3 billion Australian dollars in 5 to 10 year Japanese government bonds. So it's going to be really interesting, and Japan could be that point where if they're forced to raise the yield cap again, they could really rain on the parade of people hoping for lower rates.
Absolutely. Well, there's a lot of momentum, I think, that's going to put rates higher. And of course, if you think about the movements of bonds and how that then affects funding costs flow into higher mortgages. So you can see how this actually could be a cycle of higher impacts, not just in the bond market, but more broadly in the financial markets.
No, indeed. Okay. Now, there's been quite a few little interesting data releases related to the US labor market recently, and US job openings surprised to the upside by over 400,000 jobs, indicating that the US labor market isn't going to roll over anytime soon. And the ADP employment report, which is a private report, which basically surveys generally larger employers, concluded that the US economy created about 235,000 jobs in December. Now, I generally don't like the ADP report. It is generally wrong, but it also reflects what we've seen in Americans, a lower number of Americans claiming unemployment benefits and a lower number of Americans newly claiming unemployment benefits. And even though the ADP numbers have been wrong recently in particular, they're usually wrong to the downside. Wrong to the upside. And we are generally seeing more jobs being created than what they've said. So if that holds true again with the labour market data released tonight, then we could see yet another pressure on risk assets.
Yeah, so another reason, again, if the jobs market maintains its momentum, and wages, of course, is also strong in the US, that's going to put more upward pressure on the Fed to lift rates higher to try and actually control inflation.
Exactly.
Yep.
Okay, we had the Chinese housing minister come out yesterday and say something that was rather funny. He said that China does not support the purchase of more than 3 houses, leaving no room for speculators to re-enter the market. Exactly how he managed to determine that you're only a housing speculator if you have 4 or more properties, I don't know. But as you can see there from the graph on the left, you can see why it's politically and economically convenient for him to do so. Because in 2018, this is from a great report from Kenneth Rogoff, and basically only about a little over 10% of homes in 2018, of new homes in China, were purchased by first home buyers. The rest were purchased by people who either have 1 home or more. So China is very, very much its property sector is very much driven by speculation. If even, say, a third of those people who have 1 or more dwellings were speculating solely with the goal of capital growth, and you take that third out of the equation, the Chinese property sector falls to bits. So I think that's really something that's worth keeping in mind going forward, as China does now try to reflate its property market, at least for the time being. I'm not sure if you saw, because it was just before the show, we had the Chinese government come out and say that if property prices in a city fall for 3 months, both in month-on-month and year-on-year terms, they're going to remove the floor rate for mortgages for first home buyers.
Yep.
So basically, go nuts with the borrowing and go nuts with the systemic risk.
Yeah, and that's consistent with what they said. PBOC said a couple of days ago that they were going to do selective support for the economy, right, and property support. So it's coming through quite quickly, and worth bearing in mind how far property prices in China have fallen. And so if you're one of those that have multiple properties, the value of your wealth has been crushed. So in a way, it's not surprising now they're going to try and turn that around and let the wealth expand again. So it's the same old as we discussed in Australia earlier on, actually.
It is. And I think one thing that's really interesting is just that Chinese property is not actually that good of an investment when you really start to examine the nitty-gritty. Like, I'll give you an example. In Shenzhen, the housing turnover rate is so low that total housing turnover only occurs about once every 232 years. Right? So normally, say in Australia, housing turnover is about 5%-ish. So you see total housing turnover, at least in mathematical terms, about once every 20 years. And in places where housing is a little bit more affordable, or even Australia in the past, it's about once every 10 to 11 years. And I think that's really interesting, because in the mega city of Shenzhen, which has a population of 12.6 million, so about half the size of Australia, only 21,000 second-hand homes changed hands that year.
Yep.
And in Australia, it was about almost 500,000. So you're talking about a tiny, tiny, tiny proportion. So it's all well and good going, oh, well, my house is worth X amount of money. Well, that's not really any good if you can't sell it because turnover is so low, and the Chinese government and local government step in to stop you from selling your house at a lower price, even if you're going to realize a huge gain, you can't sell it because they don't want that sort of negative feedback loop to be created in terms of someone sells and then someone sells for even cheaper to unlock the equity gains, and well, we all know how that ends.
And of course, the point there is that whatever your property might be worth in theory on paper, until you actually successfully sell it, you don't know whether that's right or not. And there are a lot of people in Australia and elsewhere who are banking on value X. They might have a nasty shock if they get value X minus quite a big thing, simply because the market has dropped and less demand, etc., etc. But it's all on paper. It's meaningless.
Yeah, and I mean, I think it's going to be really interesting to see how the Chinese fare in trying to at least temporarily, I should say, reflate their property sector, because it's a hard thing to do when you've only got the proportion of people in China who think that property prices are going to rise now is in the teens, and trying to engineer that into kickstarting this sector that's worth 30% of Chinese GDP. And when I say 30% of Chinese, I mean for the construction sector as a whole.
Yep.
Well, that's a pretty tough ask to accomplish, and because so far, even the likes of some US investment banks have come out and they've said it's sentiment is the key. You can throw low rates at people, but if they don't think property prices are going to rise, they're not going to borrow.
Yep. People are somewhat logical.
Yeah, exactly.
Yeah.
Okay, last slide for the day, and this is of China's demographic pyramid, and we're actually starting to see the Chinese population fall, according to some sources now. Naturally, some suggest that this occurred as early as 2016, some 2018, some say it's going to be in the future. So it's really a bit of an open question. But the reality is Chinese demographics are deteriorating relatively rapidly. And I think that's well worth keeping in mind, particularly as you start to see some of these older cohorts pass away, because you've got the one-child policy. So you've got, say, for example, you've got, two sets of grandparents, you've got the parents, and you've got the child. So the child has the properties of their parents and the properties of their grandparents. So it's challenging in some ways to see where the demand for property is going to come from in China in the long term, unless we see a renewed push for urbanization. But that also requires a whole other set of different settings, and it's not really something that you can do when youth unemployment is pushing 20%.
No, absolutely. It shows you the dynamics. And I mentioned the population distribution in Australia, right? Because effectively we've got an older population and a smaller population than we were thinking that we might have a few years ago. But this China one is writ large, right? And if you think about the consumption effect, if you have a falling population and an aging population, they consume less. So that has a very negative impact on consumption and GDP. And interestingly, of course, up till quite recently, China was trying to get its population to spend more and use that as an economic engine. Well, they're sort of throwing it right into the face of a falling population base. So that may not be that successful.
No, and I think that's really interesting, because you've got the different sides of the economic debate in China, in the sense that on one hand, realistically, they should be aiming for a more consumer-focused economy. They should be aiming for boosting small businesses and consumption at a grassroots level. But it doesn't seem like that they're actually willing to make the decisions and to change who gets the shares of the pie, shall we say.
Yep.
And shift it away from corporations, away from state enterprises, away from the oligarchs, and more towards the small businesses, more towards households. I mean, say, for example, Chinese household share of consumption has dropped precipitously since the pandemic began. And, so, I mean, even just a recovery of Chinese household consumption to where it was prior to the pandemic that could provide a huge boost to the Chinese economy. But are they willing to provide the settings necessary for that to occur and to provide the level of certainty required for that to occur? And on that, I'm honestly not sure. They just, at the moment, they seem more interested in reflating the property sector and just following the same old, same old. And I will admit that's something. If that does end up being the path that they take, I was wrong about them taking a different path, because I don't think this is a positive path for China or anyone in the long term.
No, and I then make the point, this is now post that big political conference, right? So maybe there was a pre-conference strategy and a post-conference strategy. I wonder whether that's, so there is actually perhaps a political overlay here which is worth thinking about. So they actually positioned a few things to try and get the outcome they wanted at that big political event. Having now done that, they're now going back to plan A, and I suspect we're going to see more of plan A, and that may not be good for China and Chinese, but it's not necessarily good for the global economy either.
Well, I mean, if they do go back to the same old and the bad old days of just relying on stimulus fuel growth, it could be good for Australia. Maybe they're going to buy more of our coking coal and, create greater demands for iron ore. It's possible. And I mean, it's stupid. It's incredibly risky and it's really dumb, but it doesn't mean they're not going to do it. I mean, as we've learned over the last 2 or 3 years, just because something's stupid and dumb, it doesn't mean that people aren't going to do it. I mean, I think it's worth noting that when China started stimulating their economy initially, the price of iron ore was about $40, $30-$40 a ton.
Yep.
Trying to do a stimulus when thermal coal is $450 a ton and not 30 or 40, and iron ore is not 27 or 30 or $40 a ton, whatever it was at start of 2007, start of 2008. Well, you're going to send commodity prices to the moon, and you're going to create the inflation that you fear. But I mean, I think although I will say that's a really important point just for the whole, China's going to rescue us sort of narrative.
Yep.
Because if we do see a rerun of 2008 in terms of the uptick in commodity demand from China for our minerals, well, that's going to send commodity prices rocketing, which people go, well, yay, that's great. Well, if it sends commodity prices rocketing, you're going to start to see that feed into producer prices again, and then that's going to feed into inflation, and then we're going to have an inflation problem again. Now, I think people might have to look long and hard on whether or not they would like China to bail us out this time, because there could be some strings attached.
Well, I do believe the inflationary impacts could be quite significant. And of course, if you think about how we've reconfigured our exports away from China relatively compared with 2 or 3 years ago, if we then go back into that sort of, Chinese engagement strategy again, it could actually weaken our economic base, because it will make us more dependent on China again. And I'm not necessarily sure that that's actually strategically a good thing either.
Well, it's a bit like a toxic relationship, isn't it? I mean, you don't go back to the person who treats you bad, but can they say no to the money?
No, they can't, unfortunately, I fear. Well,
Australia, what a gold digger.
I was going to say, we understand how the game is played, right? And like it or not, it's about the force of big money and big corporations making a quick buck, never mind the local population, as we discussed earlier on. Well, what a lot we've covered today, Tarek.
We have. I'm actually quite proud of that, because normally we get through a couple of things and then we get sidetracked. So I think we've done pretty well.
Yeah, well, thank you very much for preparing the slides. Look forward to the next conversation in a couple of weeks. And so much is going on. We'll have plenty more to talk about then.
Yeah, I have a feeling that 2023 is going to be an even more interesting year than 2022.
Absolutely right. Well, there's more to play. And I said in one of my other shows, I think with Edwin, was that 2023 feels like 2022 plus a lot of other stuff, right? I think it's going to be a very interesting year. I think we're going to find that things will move even quicker. More data, more slides, more conversations. So at least it'll keep us busy, won't it?
It will. And, I think we ended our first ever conversation in 2019 with "May you live in interesting times." And yep. I imagine we're going to continue to live in interesting times.
I think that's a good observation, Tarek. Have a great weekend. Thanks for that. And look forward to the next one.
No worries, mate. Looking forward to it.
So yeah.
Bye.